Hey everyone, I'm Professor Stefan, and in this video we're going to start notes receivable, but really this is going to be just kind of a refresher on time value of money. So I think you guys have all seen and all done time value of money type calculations before. And so this is just going to be a reminder of sort of the terminology and what we're talking about and kind of why this matters a little bit. And then in class, when we really cover notes receivable, we're going to see how we apply this to the economic transactions that are going to demand time value of money for accounting purposes. So let's get started. So why do we have to deal with all of this stuff? Kind of simply put, $1 today is worth more than $1 in the future. And kind of put in a different way, you could say, hey, would you rather have $50,000 kind of today in your pocket, or would you rather have $50,000 10 years from now? And I think all of us, hopefully intuitively, would take the $50,000 today. And kind of why is that? Why do we all want that right now? Well, there are a few reasons behind this. One is that we could invest this money, right? We could start a business. We could put it in the stock market. We have options on what we could do with this money that would kind of potentially turn it into more than $50,000 10 years from now. Second, there is uncertainty and risk about the future, right? You're not guaranteed to be around 10 years from now. You don't know if there's going to be rampant inflation between now and 10 years from now. You don't know what that $50,000 will necessarily be worth. So why do we care about this in accounting, right? This seems very much like a financing sort of topic. Well, in accounting, there are sometimes long-term cash flows that we have to deal with. So things like notes receivable that we're going to talk about, sometimes warranties, sometimes bonds or long-term notes payables, long liabilities that you have. These are cash flows that are going to happen well into the future. And so GAAP wants to make sure that we're not recording our assets and liabilities at those future values that are actually not worth as much today. We instead want to record these assets and our liabilities at their present values, kind of the amount that it would be worth today. So we have to use time value of money techniques to do that. So let's cover some of this terminology here. Interest, as you guys know, this is basically the price of money, right? If you want to borrow money, interest is the cost of that borrowing. And usually we're going to state our interest rates on an annual basis. So it's going to be some percent of the amount that you borrowed or the amount that you lent to somebody else. That is going to be the cost of that money. And if it is a short-term type loan, we are going to use simple interest where we just take the principal balance and multiply it by the interest rate, and we get an interest expense or an interest revenue. So that's our simple interest. So what we're going to be doing in most cases for kind of our notes receivable and our bonds payable is what we call compound interest. Essentially what this means is that we are going to owe interest on interest that we haven't paid yet. So the way that we're going to deal with this compound interest situation is we're going to say, well, if our compounding period is less than a year, so kind of our baseline, we're going to say it compounds annually. If our compounding period is less than a year, so it could be every 6 months, it could be every quarter, it could be every month, theoretically, it could be every single day that we start kind of owing interest on the interest we haven't paid yet. We're first going to convert the interest rate into that kind of partial year period. So we're going to take our interest rate and divide it by the number of compounding periods per year. So if we said, okay, 12%, our annual rate compounded quarterly, we would divide our 12% by the 4 quarters per year. And we'd say, okay, our interest rate is 3% per quarter. So we're just going to convert our interest rate to a per period, basically. And then we're also going to change the number of periods. So if we had a 5-year loan, that was compounded monthly. Instead of 5 years, we would say, well, we have 12 months per year and we have 5 years. So really we have 60 months or we have 60 periods. So if we are compounding on something other than a given year, we are going to adjust both our interest rate and our number of periods to kind of basically convert it into, instead of an annual thing, we're going to do it every month or every quarter or whatever that compounding period is. And we'll see how to kind of apply that to our notes receivable in class here pretty shortly. And basically what this compounding thing does is it changes my effective interest rate because we're going to be given an annual interest rate. But if we're compounding more frequently, every 6 months or quarter or every month or every day, that is going to increase the effective interest rate that I have. So let's say Cray Inc. invests $1 million for a year at a stated interest rate of 10%, but this compounds semi-annually. Kind of what is the effective interest rate of this investment? Well, they're going to earn interest on the first 6 months, right? So they're going to earn 5% on that $1 million over the first 6 months. And then they're going to earn interest on the second 6 months. But the interest they earn on the second 6 months will include both the $1 million of principal and the $50,000 of interest that they haven't yet received. So this is where they're going to earn interest on both the principal and the unpaid interest, and that's the compounding piece. So for the second 6 months, they're going to earn $52,500 in interest. And so their effective interest rate here is they're going to earn $102,500 on that $1 million loan. And so they're really getting 10.25% in interest. So it's a little bit higher than that stated rate of 10%. So that kind of covers our, our interest and our compounding that we're going to have to deal with these long-term notes and long-term bonds. And now I want to kind of review just some terminology around time value of money. We're going to be dealing with both kind of single sums, or what we sometimes call lump sums. And this is going to be kind of the big principal payment that might occur at the end of a note or at the end of a bond. And so we can either discount a future value back to the present value, or we can accumulate a present value up to a future value amount. So let's say you had $50,000 in your bank account today. You might want to say, what is that worth 4 years from now? So you would accumulate that up with a formula where the future value equals the present value times 1 plus the interest rate raised to the n. And we're going to see how to do this in Excel as well. So if you don't want to use the mathematical formulas, or you could use a financial calculator, or you're welcome to use Excel. We'll see different ways on how to solve these things. But I is going to be my interest rate and n is going to be my number of periods. Now the flip side is maybe I have a payment coming due in 4 years, and that payment 4 years from now is worth $50,000. And I want to say, what is that $50,000 payment 4 years from now worth today? Because we know it's going to be less than that $50,000. So we could say my present value is equal to the future value divided by 1 plus the interest rate raised to the n. And that's going to tell me what that $50,000 payment, 4 years from now is actually worth today. So let's say we have Baymax Company and they expect to receive $200,000 in 4 years. We want to say, how much is this worth today if the relevant interest rate is 12% compounded quarterly? Well, what we're going to do is we're first going to kind of adjust for the compounding. So we have to adjust our interest rate because they have 4 periods per year. So we're going to take the 12% and divide it by 4 quarters per year. So we've got an interest rate of 3% per quarter. And we're going to adjust our n as well, our number of periods. So instead of 4 years, we have 4 quarters per year. And so we really have 16 quarters across this period. So we're going to work with an interest rate of 3% per quarter and 16 quarters. And then we're going to use this present value formula where we take the future value of $200,000, that future lump sum, say, what is that worth today? So we divide that $200,000 by 1 plus the interest rate, 1 plus 0.03, raised to the 16, raised to the number of quarters in our calculation. And so this future $200,000 payment is really only worth $124,000 today. If you wanted to plug this into a financial calculator, you could say your future value is 200K, your N is 16, your I is 3, and usually there's also sometimes a payment option, a PMT. You would just set that at 0 for this one if you wanted to try and solve for this. Now, that kind of covers our lump sums. The other option here is instead of kind of one payment sometime in the future, or a loan today, you could have periodic payments every year or every quarter or every month. And this is what we're going to call an annuity. So kind of equal payments every single period over some length of time is an annuity. And in most cases, we're going to assume that we're dealing with an ordinary annuity where the payment comes at the end of each period. But the other option is we have something called an annuity due, where the payment occurs at the beginning of each period. And we're just going to have different formulas. We're still going to do present values. We're still going to do future values to say, what is this series of payments worth today? Or what is this series of payments going to be worth, at the end of my period? So we're going to do the same types of calculations, but now instead of a single payment, we just have multiple equal ones, every month, every quarter, every year. So if we wanted the present value of an annuity, or what is a series of future payments worth today, we could say that the present value of this annuity is equal to that payment amount times 1 minus 1 over 1 plus I to the n, all divided by I. Kind of a complicated formula, but honestly, it's, you follow the formula, things work. We're also going to see again how to do that in Excel or a financial calculator. And if you wanted to ask what is the future value of a series of payments that are going to occur, We have another formula that's just the payment times 1 plus I to the n minus 1, all divided by the interest rate. So again, just different formulas, but still what we want to just be able to do is say what is the future value of something or what is the present value of something. And so if we have Callahan Investments and they deposit $20,000 in a 12% fund, so it's going to earn 12% interest at the end of each year for 8 years. Beginning December 31st of year 1. So this is an ordinary annuity. The payments are occurring at the end of each year. How much will be in the fund immediately after the last deposit? So kind of what's the future value of all of these payments that Callahan Investments is going to make? And so we could plug this into our formula here where we take the payment amount of $20,000, we multiply it by 1 plus the interest rate, 1 plus 0.12 raised to the 8, the 8 years. We subtract 1 in the numerator, and then we divide by that 12% interest rate. So at the end of these 8 years, those $20,000 payments are going to be worth $245,000 or $246,000. If you want to plug this into Excel or a financial calculator, the payment will be $20,000, the N is 8 years, and the interest rate will be 12%. So we need time value of money because we sometimes have payments or receipts very far in the future. And so we want to make sure we're recording those on our balance sheet at the present values of those assets or liabilities. Now remember, present value is what some future cash flows are worth today. And future values are what some cash flows either today or in the future are worth at some future date. And we want to be comfortable with both lump sums and annuities. They have different formulas. But when we get to notes receivable and kind of our bonds or our long-term debt, we're going to combine these things into sort of one calculation. So we're going to have notes and bonds that have both lump sums and annuity payments along the way. So we're going to have to deal with both of these together. Thanks for watching.